G'day and welcome to this week's video. My name's Robert Gowdy from Consortium Private Wealth, and today we're going to consider what makes a great investor. And there's so much information out there in terms of what PE ratios are and all the fundamentals around businesses, the debt levels, the earnings growth, the analyst projection. So you can go into Yahoo Finance and you can see whether if there's a company, say like Microsoft, they will be providing, all the analysts will provide their buy, hold, sell recommendation, and all that is there, for the general public to see for free. So there's plenty of information out there, but what's more important, what makes a great investor is perhaps the knowledge. And it's not about those fundamentals. It's about, say you do go into Yahoo Finance and you do look at Microsoft, and that's not a recommendation to buy, general advice only. You see Microsoft is a strong buy by 30 different analysts. So you buy. From there on, it's an emotional game. It's the psychology of investing is what I think is more important to make a great investor. And generally it's what happens when things go bad, when the market crashes. And I've been doing this for nearly 26 years. I've seen the tech wreck of 2000. That was a long drawdown from 2000, 3 years all the way to March 2003. Then the GFC, 08-09, that was huge ramifications. And then there was the COVID crash, which was down in Australian terms, 37%. And there's been many more corrections along the way. So it's how you behave when things turn bad. It's how you behave when the market goes up. You've just had a great return, then you start buying again because you've had a good past return. And it's important to know that when markets are up, everyone looks good. It's when market down is when the people make the tough decisions, because the feeling of when you lose money, or just that short-term volatility, you watch your portfolio go down, the feelings of anxiety of when it goes down, you think, can it go down further? Will this go to nothing? And the stress kicks in. That's what forces people to sell. So keeping a cool head during these tough times is essential. Watching your fund on a daily basis is no help at all. And when the market goes down, I think not watching is a really valid strategy. If you're used to watching it as the market went up and it makes you feel good, conversely, when markets crash, they'll go down very sharply, and they often say, down in the elevator and up in the escalator is an old saying that that it's going to be very stressful. So not watching is a real valid strategy. What I do for my clients when we have those really torrid times is I help them make the right decisions at the toughest times. So if the clients that have no more money to invest, we will make sure that their advice is hold the high quality businesses that you've got. Do nothing. And as I said, stop looking. These times will turn around. If we've got clients that still have money to invest, or a newer client that's coming on board, we're progressively investing, these are an opportunity to buy. Now, there'll always be that feeling that if we wait, will it go down further? It may. We can't predict what might happen in the short term. So it's understanding that in the short term will be dictated by the world's calamities, wars, natural disasters, and so on. The long term will be dictated by the people running these businesses, improving the products and services, which therefore will increase the revenue and the profitability, and therefore the value over the long term. So to me, a knowledgeable investor, someone who is patient, who makes the right decisions at the toughest time, that's who makes a great investor. And for clients of financial advisors, and I know for my clients, when those tough times hit and the advice they get, that's some of the most important advice that you're going to get. So someone to guide you through the tough times is vital. Otherwise, if you're going it alone and the anxiety kicks in and you're a forced seller, well, generally every time I've seen someone that has sold during a crash, it's been a mistake in hindsight. I'll get out now and I'll get back in when it's a bit better down the track. Well, that's essentially saying that I'll sell when it's down, then I'll buy back in when it's recovered, as in gone back up a bit when they feel safer. So that's what makes a great investor. I encourage you all to keep learning, keep reading, keep watching the videos, and by all means provide us some feedback, and yes, throw us another topic you'd like us to cover. We're happy to do so. Thanks for listening, and see you next week. Cheers.